Get Rich Education is brought to you by Norada Real Estate and GREturnkey.com.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to GRE, Get Rich Education, episode 144. Hi, I'm your host, Keith Weinhold. What's going to happen if there's a great economic crash? I'm talking about more than just a housing and stock market crash, but a broad economic downturn like a contraction in national GDP, stifled wage growth, and high unemployment. Well, then how would you want to be positioned? Well, I'd want to be invested in something like low-cost housing, because that's something that's going to have sustainable demand. Even in a downturn, affordable housing is not discretionary. People are going to keep needing it. I'd also ideally want to own low-cost housing where tenants could keep paying the rent in a downturn, because it's no good if affordable housing is occupied and yet someone can't pay you the rent. Okay, so that means in a downturn, that tenant would need to have durable employment in sustainable and growing business sectors like healthcare or technology. It might even help if that metro where I were positioned in low-cost housing had some employment in the educational space. Education runs counter-cyclical to the economy. When there's a crash and people have a harder time getting jobs, they go back to school. And as you know, as time goes by, geography means less and less to connectivity, and it means less to economies, which actually kind of pains me because I'm a geography guy. But geography still matters substantially in real estate. Location, location, location. So in a downturn, I would want to have it all. And if I could have it all, I would also want to be in a market that is well positioned logistically, that has a central location. Now, 2 weeks ago, I discussed how I made more money in the 2008 and 2009 financial crash than I had previously. Basically, when people couldn't get loans for real estate, they couldn't buy, and they had to rent from me, and I could charge more than ever for that rent amount. Indianapolis, Indiana has so many of the cash-flowing real estate market attributes that I would want in either healthy economic times or in a downturn. So our guest and I are going to discuss that today. But before we do, I want to tell you that next week it is going to get quite interesting here, because we're going to talk with a financial advisor here on the show. Yeah, a financial advisor, someone you might think of as the enemy almost in a sense, okay? Because it's someone that's licensed to sell you stocks, bonds, and mutual funds. And this guest has begun to realize that a lot of those products are a bunch of BS. BS stands for blue sky, of course. So he's begun investing in cash-flowing real estate himself. It's going to get quite enlightening to get his perspective. That's next week. Today, let's talk about the cash-flowing residential real estate market in Indianapolis. Welcome to Get Rich Education, Aaron Adams.
Hey, Keith. Thanks for having me.
Yeah, it's really good to have you here. So, Aaron, just tell us a bit about how you got started in real estate.
Like many, I was always fascinated by the idea of investing in real estate. Back in 1999, I was living in Southern California, teaching high school. Late at night, Carlton Sheets came on pitching his No Money Down. I'm sure you remember that.
Yeah.
And it was a 90-minute infomercial. I actually found it on YouTube a couple of months ago in its entirety. And he did an excellent job of painting this picture of owning passive real estate. And that drove me to Barnes & Noble, where the first book that I read was Rich Dad, Poor Dad, someone and something that I know that you have a ton of experience with. And that book lit me on fire. It got me really excited about this idea of being a real estate investor. Ironically, even though I was teaching a high school, I had been working on a master's degree in business, which I finished at Cal Poly in Southern California. And what was so interesting to me was that I had these professors who I thought they would teach me how to make money and run a business. And it was so much more specialized, the content that I was getting in. None of it was very that practical. And that began kind of an educational journey. I attended a boot camp with Bruce Norris in Riverside, and he taught us how to flip houses. And I went out and bought my first duplex in 1999 in Hemet, California for $100,000. Convinced my wife to move into one side with me. We rented the other side and were able to cover our principal, interest, taxes, and insurance. And much to our surprise, 6 months later, the California real estate market, which we didn't know it at the time, but was soon to become the hottest appreciating market in the country between, roughly 2000 and 2006, 2007.
Yeah.
As a high school teacher, I was in the middle of it. We flipped that duplex 6 months later and netted $50,000. Another teacher at the high school loaned me $250,000. And that kind of started my journey of I would get a seller carryback on a deal, put 20% down, get a year to pay off the property, fix it up, and then flip it. And year 2, I flipped 3 properties, a 7-plex, another duplex, and a single family home. And at that point, I was off to the races. I got my broker's license, and between 2000 and 2004, I made my first $1 million in that Southern California market. About that time, obviously I learned about cap rate, I learned about cash flow properties, and one of the things that really freaked me out was that by 2004, you really couldn't make much more than about 3 or 4% on a rental property in Southern California when you looked at rent rates correlated to all-in numbers. That first duplex that I had purchased for roughly $100,000, bringing in $1,500 a month in gross rents, someone put it on the market for $350,000 in 2004, $350,000. It was still only bringing in $1,500 a month in rents, and that really kind of gave me pause and made me think, this isn't sustainable. And so I started to look around the country to try to identify an area where I could get double-digit returns just from the cash flow. And I quickly realized that the only place to do that was in the Midwest. From there, I started to really look at factors like unemployment, population growth, state governments and how business-friendly they are, some of those kind of macroeconomic indicators that would point to a healthy rental market. I mean, anybody can make money in flips. You can do flips in Detroit right now. On a rental property, you're really buying a business in that state. And so I approached it much more differently. And Indianapolis just kept jumping out to me as an area that would be good to take the $1 million or so that I had made flipping and safely protect it. And so I started to attend auctions in Indianapolis in 2004 and buy some properties, and was really thrilled to see, getting $600, $700, $800 a month for $40,000, $50,000, $60,000. And that was just not possible. I didn't even, the only thing you can get for $60,000 is a BMW in California. And so once I saw what the potential was, in January 2005, I set up in Indianapolis. I set up a construction company. I got my broker's license, and we set up a brokerage, construction and management, and started to buy properties with myself and a couple of partners. 6,000 properties later that I've purchased in the area and in other markets. We've never really strayed from that focus on finding markets that are good for holding property. And then we vertically integrate our structure to handle the properties from start to finish.
Yes, you've really set up operations there in a turnkey fashion to make it convenient for the investor. Not everyone has the time and the interest and the inclination to do what your wife and you did with your duplex in California there. And with the selection of Indy, yeah, it sure is interesting, and it's a market that's gotten a lot of attention. Now, the Midwest is a lower cost place for living than most of the U.S., and then even within the Midwest, Indianapolis has a low cost of living. And over time, Indianapolis has really kind of shown to kind of exhibit this sort of slow, steady, and long-term growth. So talk to us about some of the drivers there in that Indianapolis market, Aaron.
Having come from the West Coast, and I grew up on the East Coast in New Jersey, I meet coastal investors, and they think of the Midwest as just a giant flyover farm.
Right.
And they mistakenly lump the Rust Belt with a lot of other markets like Indy. So they think, well, that's auto, that's farms, that's, not something that's going to grow. And it's such a mistake to do that because, certainly you do have markets like Detroit that since the 1960s have contracted their population by 60%. But at the same time period, Indianapolis, from a population standpoint, has increased its population by 60%. And why are people moving here? Well, our governor likes to call Indianapolis the Silicon Prairie, which I hate that designation. I think it's about as corny as you can have out there. But tech has become a huge industry. The largest building in downtown Indianapolis used to be named the Chase Tower, and it's actually the largest building in the state of Indiana. But Salesforce.com now have their largest headquarters outside of the Bay Area in Northern California here in Indianapolis. And with that, downtown here, we've seen millennial growth for our 18 to 34-year-olds that's been off the chart. And they're coming here for tech. They're coming here for healthcare. A lot of people don't realize that Blue Cross Blue Shield, Anthem Insurance, is world headquarters right here in downtown Indianapolis. So healthcare is big. Behind California, Indiana makes the second most medical devices of any state in the country. So manufacturing is big. We have Allison Transmission, Cummins Diesel, which is a $2 billion company. Their world headquarters is downtown. And of course, pharmaceuticals. Many people have heard of Eli Lilly. And so when you look at kind of a census breakdown of jobs in Indianapolis, whether it's 60,000 jobs that are directly related to our convention and tourism and racing and sports industry, or whether you're looking at the number of universities that we have in a population of 2 million, there's 100,000 full-time students between University of Indianapolis, IU, Purdue, Butler University. Education is a big business. Healthcare is a big business. Tourism and sports. A lot of people know of Indianapolis because of the Indy 500, which we just had. And it was funny, in 2012, we hosted a Super Bowl in downtown Indianapolis, and people from all over the world said, wow, you guys really know what you're doing with these big sporting events. And we kind of laughed because, only 60,000 people sit in our football stadium, and the 2.5-mile Indianapolis 500 track seats 250,000 people. And so that was a small sporting event for us in terms of hosting. There isn't any one industry that dominates the landscape here. And so that's been a fantastic thing for employment and for jobs. And that's been the driver behind why people are moving here. And you have some of our surrounding states like Michigan or Illinois where there's a mass exodus. Chicago is actually contracting, and, the state of Illinois is almost bankrupt. And so you see those kinds of things. And those are important when you're looking at buying a business, AKA a rental property in a market.
Now, I think we should acknowledge the fact that the Midwest is not growing as fast as other regions. But we don't want to oversimplify, because within that region, Indiana in the Indianapolis metro is growing. Kiplinger's has named Indianapolis one of the best U.S. cities for starting a business. CNBC named Indy as one of the top cities to relocate to. Forbes named Indy as number 4 for high-tech industry job growth. So you do have a lot of those drivers, and it's not just in one industry. And I really wouldn't want to hear that it's just in one industry, because that would be vulnerable and riskier for an investor. Indianapolis, it kind of fits that profile where people and millennials are moving to, because they want to be in an urban area for the social aspects, but yet Indy is one of those lower-cost urban areas.
Yeah, it really is. When I started Alpine Property Management back in January 2005, I bought a condo downtown for $400,000. And at that time, there was only 3,000 housing units in the downtown population. Since then, so basically in the last 10 years, 12 years, there's now 14,000 housing units. And the downtown population has exploded, and mostly with those 18 to 34-year-old millennials. So not only are all the sports venues downtown, but, the big nightclubs, the big restaurants, the cultural events, they're all located. And when you look at cities and when you look at city growth and development, when you have a vibrant core that extends out to all of the suburbs, it's a critical thing. You go to some other cities that aren't as financially and aren't as healthy from a job standpoint and a fiscal standpoint, you see a city core that, oftentimes there's war zones in the downtown, and it's not a people or business friendly place to function. And you see, when you have a tax base that's non-existent, it does hurt the overall economy, and it becomes a big factor. So we look really hard at that when we look at markets.
The Indiana state finances are in really good shape. The state has a budget surplus and a AAA credit rating. And in fact, the plan is for Indiana's corporate tax rate to be lowered in coming years. So that bodes well for the continued support of business and industry there. And one of my degrees is in geography. I think in geographic terms an awful lot. And in Indianapolis, I kind of think that we have nearly the opposite effect of what we do in San Francisco and New York City. Now, those are sort of extremes. In San Francisco and New York City, we have water on many sides, and geographic constraints like that really limit the supply and push up prices, and that can make both the cost of business and the cost of living high. But there are almost no geographic constraints there, like oceans and mountains and rivers, and those low prices are really business friendly and friendly to having people relocate there.
Yeah, I think, 100 years ago, the city leaders said, we don't have a Great Lake, we don't have a Mississippi River, we don't have oceans, we don't have mountains. The only thing we can do to attract business is to be business friendly. Now, logistically, we're right smack in the middle of the country. And so logistics is a big thing. There's huge FedEx and UPS facilities here, and Amazon has set up an enormous distribution center because logistically we're right in the middle of the country. But that's also what has driving our robust convention business. We've become a top 15 convention market because we built a brand new convention center back in 2012 that coincided with the Super Bowl, and we've promoted it like crazy. And, yeah, sure, people like to go to Vegas for conventions or down to Orlando, but when you're looking at flights and distance, that becomes a big deal. As a state, there's only 12 states that have a AAA credit rating. Indiana is one of those states. Every year when they go to do their budget, they say, we have to take what we think we're going to bring in this next year from tax revenues, and every budget in the state has to match that. And so not only do we have a $2.2 billion sitting in the bank, but we generally run from $35 to $50 million budget surplus every year. Indiana has really been a model of efficiency. Now, why does that matter to an individual investor? Well, if you're going to buy a rental property in Indianapolis as an absentee landlord, you're buying a business here. That business has entities like LLCs that it needs to buy. It pays income tax every year. You pay property tax every year. You're dealing with construction and permits if you do work on the home. And when you're operating a business, when it's in a climate where the state and the city have plenty of money in the bank, have a great credit rating, and aren't worried about going bankrupt, to contrast, the opposite of that would be a state like Illinois right now, which is just a train wreck, then it makes it cheaper to run that business. I mean, I made my first $1 million in California, and I can tell you, as a business owner, it's a nightmare to operate in California. I had to get permits for mailboxes. And the opposite is the case in a state like Indiana, where they're good with their money, and it's very, very business friendly. And the state and the city have realized that. And to the extent, Keith, that they put billboards up at the state line between Illinois and northern Indiana by Chicago, promoting the tax rate to businesses to bring your business from Illinois and Chicago down to Indiana. We'd love to have you here. It's really kind of funny.
A magnet right at the border.
Yeah.
Well, Aaron has this big picture view. He's invested all across the United States. He has quite a bit of experience with foreign buyers, so he has quite a macro view of things. When Aaron and I come back, I want to ask him, what if there's a crash? How is a real estate investor positioned in Indianapolis? You're listening to Get Rich Education. Our guest is Aaron Adams. More when we come back. I'm your host, Keith Weinhold. Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME.
Are you having a hard time finding great investment properties? Unfortunately, the best deals are rarely found locally. Successful investing begins with the right properties in the right markets. Norada Real Estate provides everything you need to invest in the best deals across the U.S. Our simple, proven system will help you create real wealth and passive monthly cash flow. Get your free copy of the ultimate guide to passive real estate investing at noradarealestate.com/guide. That's NORADA realestate.com/guide.
This is America's Money Answers man, Jordan Goodman. You're listening to Get Rich Education with Keith Weinhold. And don't quit your daydream.
Welcome back to Get Rich Education with our guest, Aaron Adams. Aaron, seems to be an increasingly popular question to fear a crash and to wonder about an overall economic crash and just how a real estate investor is best positioned in a crash. Talk to us about that.
It's interesting. Just to share with your listeners, one of my favorite websites for empirical study is the Harvard Joint Center for Housing Studies. If you just do a Google search for Harvard Joint Center for Housing Studies, there are many, many, many free empirical articles about what's happening in housing in this country. And there a few months study came out that just really fascinated me because I did my first deal 17 years ago. I made my first $1 million by 2004. and then relocated to the Midwest in 2005. The market crashed in 2008, and I made more money during the crash, 5 times more money in the years of 2008, 9, 10, 11, and 12 than I had made in all the years combined beforehand. And so I've already been through a crash, and I knew what the signs were before. I mean, I moved my whole business from sunny California to the Midwest, and people thought I was nuts. There were some things happening when the market crashed the last time that are not present now. Let me recap a couple of those for you. When the market crashed in 2008, we were several million homes overbuilt in the United States.
Right.
Builders got free money from banks. Banks were giving homeowners free money. They were giving builders free money. And in 2008, pretty much going back to 1980, we need to build about 1.7 million new units a year to keep up with the homes that we tear down, the homes that become obsolete, and just natural birth rate and population growth. And when you look at how many homes builders actually build, there's a huge disparity. And for many years, it kind of followed the market as a whole, the stock market. But in 2008, we only needed 1.7 million homes, and we built 2.1. In 2007, we only needed 1.7 million homes, which was kind of what we've needed, and we built 2 million. And so for basically going back to 1996, we had been building too many homes in this country for almost 11 years, and so we had this huge surplus. The opposite has been the case for the last 10 years. When the market crashed, builders went bankrupt, they stopped building, banks stopped loaning. At the bottom of the market in 2011, we only built 600,000 homes, but we still needed 1.7 million. So it only took us about a year to sell off all the surplus inventory. And now for the past 6 years, we've been underbuilding in this country, and specifically in the first-time homeowner neighborhoods across the country. As someone who has built homes, I'm actually working on a development right now out in Idaho. I can tell you there's no money building entry-level new construction homes. It's all about upgrades, building the middle-class and upper-middle-class homes. That's where you make all your profit. One of the big differences between 2008 when the market crashed, we had too many homes. We had a glut of homes. Now we're underbuilt by several million. So when people say, is the market going to crash? I always say, well, we need more homes as it is. So what would happen if the stock market crashed? I think you'd see some softening in real estate prices, but you still have a lot of people who are sitting on the sidelines who have good credit, who have the down payment necessary, who could qualify, but haven't quite been where they need to be with their debt to income ratios because home prices have outpaced wages for the past few years. And so they would jump into the market and shore it back up. And so we wouldn't see the free fall that we saw before. Another dynamic that was present in 2008 that we don't have now is subprime mortgages. Some people call them liar loans. Back in 2006, 2007, 2008, many of you remember, all you had to do was have a good credit and a tax return, and you could qualify for 100% of the value of the home, 125% of the value of the home. Dodd-Frank legislation ended that, and we really haven't seen the resurgence of subprime mortgages like we had prior. And so a lot of people were buying homes that had no business buying homes in 2005, 6, 7, and 8, and they're not buying homes now. And that, to me, is another sign that the market is not going to crash. Another is credit scores. You could get into a home for 640 back before the market crashed. Now it's still 720. When you kind of look at all of those metrics, certainly if the stock market goes into free fall, you would see some softening of home prices. But at the most fundamental level, we don't have enough housing in this country, and there's never been a better time to be a landlord. And I point to 2 indicators at the national level that support that. Number one, since 2012, many Americans have no clue and they don't realize that Wall Street, with hedge funds and private equity, has bought up 3% of the homes in America. How do I know this? Because I've been buying for them. And we've bought hundreds of homes and continue to buy hundreds of homes for big Wall Street funds. That is unprecedented. That never happened prior to 2012. The other big factor that we have a lot of experience with is international money. We've sold hundreds of properties to investors from China, Hong Kong, Singapore, the UK, Canada. They all want U.S. properties. They want their money in the dollar. They love that they can get title insurance and property insurance. The insurability of their investment is something they don't have at home. And they also realize that Americans have never had the low levels of home ownership that they do now. We are in an unprecedented phase of low home ownership in this country, and we're at levels lower than what we were during the Great Depression. And a lot of people are getting nervous that our millennials and our Gen Xers aren't buying homes. Now, there's a lot of factors for that. There was an article that came out in May that talked about U.S. household debt. We reached a record high for debt. And when I saw what we're borrowing as Americans, it was disturbing because the two largest increases of debt for Americans were auto loans at 44%, well, almost $2 trillion, and student loans. And both of those kinds of debt hurt your debt to income ratios when you're trying to buy a home. And so not only has housing been increasing, but the ability to borrow has been decreasing for our youngest Americans, basically our 18 to 50-year-olds. And very few of them have the down payment or the debt to income or the credit that they need to buy a home. And that's why we see these unprecedentedly low levels of home ownership. So it's really interesting because we're really in a period here that we've never been before. Americans don't have the ability to buy their own homes. The demand is strong because we're underbuilt. International investors know that, and they're snatching up homes. And so do the wealthiest Americans, the Wall Street funds. And I can envision a period in 15, 20 years where the norm is that people are renters and not homeowners. And that would take us all the way back to pre-1950s when only 40 to 50% of Americans owned home, because our peak was in 2005 when almost 70% of Americans owned home. But we've really been in free fall, and it's new territory. And so I say, I tell people all the time, there's never been a better time to be a landlord than there is right now.
Yeah, you're such a good researcher there, Aaron. And that earlier source that Aaron cited, the Harvard Joint Center for Housing Studies, you've probably seen that cited in quite a bit of media, and I'll be sure to put a link to that in the show notes for you so that you remember to go ahead and take a look at that yourself. Well, Aaron, let's talk about numbers somewhat. What can we typically look at for a turnkey single-family home rent-to-value ratio-wise there in Indianapolis?
We have a lot of clients. It's really interesting. Years ago, maybe a decade ago, I had a friend say to me, did you know that you can take your money in your IRA or in your 401k and have your IRA own an investment property? And I didn't know that you could do that. I thought you had to kind of keep it with Fidelity or Merrill Lynch. And self-directed IRAs are something that a lot of investors have been utilizing. It was funny when Mitt Romney ran for president, I noticed that on part of his financial disclosures, he had $300 million sitting in a self-directed IRA. And I thought that was amusing because he can only put the same $5,500 a year into his IRA that I can put into mine, right? So how did he get it? Well, he invested in what he knew and he made phenomenal returns. When you look at a company like Fidelity, they typically average about 4% for their clients per year and charge them 3.9% in fees. And many of you have seen that if you're not putting money in your IRA or your 401k and it's being managed by a Fidelity or a Merrill Lynch, you're really not making huge returns. And so our biggest client in the U.S. are investors who are taking money in IRAs or in 401ks and buying property. And what's appealing to them is the fact that they can make 7 to 10% from the rents, 5 to 10% from the appreciation, and then tax benefits from owning the property. So typically a deal that we sell in Indianapolis is $50,000 to $70,000, completely fixed up, completely rented out. We call it turnkey. I know you call it the same. We then manage it for the investor. Many investors will have their IRA buy that property from us. And then every month I send the $500, $600, $700 a month in rent to their IRA as the growth. So the quick ratio I usually say is for every $60,000 that you buy in property, you can net $500 a month, $450, $500 a month after taxes, management, and insurance. And so a house that we sell for $60,000 is usually rented for, let's say, $700, $750 a month. It's a very typical ratio. Now, obviously, you can go into some of the low income, high crime, low home ownership neighborhoods and be all into a home for $15,000, $20,000, $25,000 and get $500, $600, $700 a month rent. The problem that I found with those properties over the years is that the liquidity on them is low. It's difficult to get rid of them when and if you need the cash back. Whereas the homes that we sell typically are in those blue collar, first time home ownership, working class, middle class neighborhoods that are so underbuilt in our country by contractors. And so every month for our clients, because we own a brokerage in Indianapolis, we assist them in when they're ready in selling the property. I say to my clients, all you have to do is pay the taxes and the insurance once a year, and we take care of the rest. We take care of the calls. We have the construction crews to fix up the properties, and we send the rent check every month.
Now, for turnkey, you have your own management property that you began long ago right alongside them, and you manage an awful lot of properties. So just tell us about the vacancy rate that your management company deals with there in Indianapolis.
It's kind of funny. Like I mentioned earlier, I've purchased almost 800 homes for big Wall Street hedge funds. In December, one of the funds that we work with asked me to come to their offices in Midtown Manhattan and explain to them why our vacancy rate was so low. And so I go to Midtown Manhattan in a building right by Trump Tower down in Midtown, New York. You get whisked up to the 30th floor, and there's a room full of suits. And they say, we own 5,000 homes, and our typical vacancy is over 20%. We want to know why you guys are at 8%. And I said, obviously we've refined screening over the years. I've bought thousands of properties, and we've learned that you actually just pulling credit, just pulling criminal and background isn't enough. You need to call the prior landlord. You need to verify their income. And we have quite a multi-step process that we go through. But the biggest thing is we hold ourselves accountable every month. So for example, in Indianapolis, we have 1,500 rentals, and we kind of go into code red status when we get to more than 8 defaults in a month. And I think that's, extremely low. But anytime we do have an eviction, we go back and look at what we may have missed from a screening standpoint, a system standpoint that we could potentially catch going forward. And so we've just rigorously attacked that over the years. And so we're very proud of the fact that our eviction rate is a single digit rate, and so is our vacancy. We have our own leasing company as part of our umbrella of companies in Indianapolis. And so when we're finishing homes at the 70 or 80% level, our leasing agents are already marketing those to prospective clients. We generally only allow 1 in 20 tenants that apply to move into our properties. And we usually have a waiting list for properties so that by the time that work is completed, we have a tenant ready to move in within a couple of weeks. And it just speaks to the fact that when you outsource your operation, it adds a layer of complexity that can be volatile.
Right.
I just made the decision that even though I didn't really want to be a property manager, even though I didn't want to own a construction company, that if you can't control your environment, it makes it harder to get predictable results. And so as I explained that to the Wall Street guys, they kind of nodded their heads and then tried to buy our whole operation, which we weren't interested in.
They like what you had to say a little bit too much. Aaron, any last thing the Get Rich Education listeners should know about turnkey real estate investing today, or the Indianapolis market, or anything else at all?
One of the things is I usually encourage people to kick the tires. Now I meet investors who are savvy and they reach out and say, hey, send me some properties. I want to buy one. And you would be that kind of investor where you've been around the block, you've done a lot of deals, you can see the writing on the wall, and you can invest comfortably. But for many people, we encourage them to come do their due diligence. We love having investors come see our operation. We love bringing them to Indianapolis to see what we do, how we operate, to meet our team. We're very proud of what we do and the operation that we have. And so I would encourage investors to always do the due diligence. Last week, for example, I got a call from a friend of mine in Kansas City, and he said, you need to come see this commercial project for $2 million. And I didn't want to go to Kansas City. I ended up having to take a 7 a.m. flight and then flew back home on the 7 p.m. flight 12 hours later. I was exhausted. But if I'm going to spend $2 million, I'm going to buy a $400 plane ticket and go see it. I mean, look, I love armchair investing after I've done my homework. And so if I can encourage investors to do one thing, go kick the tires, go see the operation, and really do your homework, because when I find that people have been blindsided or didn't get what they thought they were getting, that's usually one of the first things that pops up as not having happened.
Well, that's a great tip. And another thing to do is at Get Rich Education, we often make sure that you have a report put in front of you so you can learn about and read about a market before you buy there and before you get connected with that provider. So the best action-taking tip for you is to go to getricheducation.com/Indy or getricheducation.com/Indianapolis. Either one will take you to the same place to get a great report on Indianapolis turnkey real estate investing that Aaron put together. Aaron Adams, thanks so much for coming on to Get Rich Education.
Thanks for having me. It was a pleasure.
Yes, great stuff today. Indianapolis, Indiana, one of the best cash-flowing real estate markets in the United States. Again, next week, we're going to be talking to a financial advisor that has come to realize that the stocks, bonds, mutual funds, and ETF products that he sells really aren't always in his client's best interest, so he's begun investing in real estate himself. I'm going to ask him about how exactly that is going. As far as today, grab the report about how you can learn more and, if you so choose, get in the game with cash flowing turnkey property in Indianapolis. You can do that at getricheducation.com/Indy. Until next time, I'm your host, Keith Weinhold. Don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.